We are continuing with our Outlook 2021 series. Our theme this year, finding equilibrium after the chaos of 2020. Joining me today is Nick Barisheff. He is the author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. He is also the founder and president of Bullion Management Group, otherwise known as BMG. Nick, I know we've been following each other's careers for a very long time. Nice to finally have you on.
Well, it's great for having me. Thank you, Daniela.
So your book, it's quite a headline here, $10,000 gold. It's a bold prediction. My question to you, Nick, after having covered gold for more than a decade is, look how long it took us to get to $2,000 gold. What's the path to $10,000?
Well, it's actually an exponential function because the price of gold in US dollars and total US debt were correlated until 2011. So they've fallen off since 2011, and they're now it's trying to equalize again. So if it was to go to the historical correlation, we should be in about the 2,500 range right now, based on the added U.S. debt. So we've had a historic amount of debt added in this year. And the thing to remember is the debt that was added this time had zero contribution to GDP. And it was bad enough before, because it used to be that for every dollar in debt, you get a dollar in GDP. Then it dropped to where you were getting $4 in debt for $1 of GDP. Like that's a formula for chaos. But then this year came along and they created all the money to pay people not to work. Next year, they're going to have to figure out how to get everybody back to work. And it'll be 4 to 10 times that amount, in my opinion.
Nick, what happens when the Fed stops expanding its balance sheet? Because right now, all boats are getting lifted.
That's right. But I don't think they can or will. If even they hint at slowing down, the market will crash. In terms of the stock market, it's the most overvalued equity market in history, including 1929, by every conventional measure there is. The bigger problem is, while the market's been rising, corporate earnings have been declining. Normally, they're correlated as well, but now they've diverged and are getting wider. So it's just not a sustainable situation. So they'll be forced to print ever increasing amounts.
Nick, what's your response when people say, "Well, look, Nick, you run BMG. It's a company focused around precious metals sales. So are you just talking your book here by saying $10,000 gold?"
Well, at the time I wrote the book, it was 2011. So timing wasn't great because we went into a correction in gold prices. And at the time, whenever I was interviewed, they would ask that same question. And I felt like a lone wolf in the wilderness because I'm the only one that said that. But now you interviewed them, whether it's Jim Records or Jim Rogers. So $10,000 now sounds like a conservative estimate.
That's true. That's true. So just going back to the point about the Fed, you don't see the Fed stopping their asset purchases a year from now. You don't see that as a likely scenario, Nick?
No chance I can see that.
Okay.
They'll have to keep that up. And likelihood is that the stock market will probably have a final leg of irrational exuberance. So it'll go even higher, before it turns.
One of the chapters I find interesting is how you make the point that gold never sleeps. And many investors would say, well, what about all those years that it was in no man's land? Like, yes, 2020 has been an exciting year, but what would you say gold is doing now?
Well, first of all, most people are surprised. We've done a chart showing the gold price in all the major currencies since 2000. So in US dollars, the average increase was over 10% in US dollars. And across the board in all the currencies, it was nearly 12%. So when you say, well, pension funds target for 6%, and many of them don't get 6, whereas gold has done 10, and it's only had one bad year, which was 2011, of a minus 24. All the rest of the years were positive. So while it's boring and nothing's happening, it's outperforming the indexes. I mean, it's not competing with the Amazons and Googles, right? But as far as the broad index or a balanced fund or anything like that, it's outperforming them. And all you're doing is keeping gold in a vault.
Nick, if you're so bullish on gold, are you expecting a US dollar crash?
Well, it's already crashing. I mean, since 1971, in purchasing power measured in gold, it's declined by 98%. And in the book, there's a few tables that showed the price of a house in ounces of gold, the price of a car in ounces of gold, and compared to how many ounces and so on. So all of those major expenditures declined in terms of how many ounces it took to buy a house, a car, or whatever, the Dow.
So Nick, let's talk about exposure to gold. What are, how are you exposed? Are you 100% in gold?
Personally,
Yeah.
yes.
And
And
is that
all the working capital of BMG is also in, well, gold and silver, precious metals.
so do you like, is it a mixture of physical mining stocks, ETFs? What does it look like?
No, I've in the early days from 202 to probably about 210, I was about a quarter invested in mining stocks, and it did well. Then I got a little nervous because it wasn't making any sense. So my point is that when the market crashes, the mining stocks will decline by more than the equity markets, even if the price of gold is going up. So it's at that point that you want to buy mining stocks because it'll be the deal of a lifetime.
Interesting. Why would you say that happening if the price of gold is rising, though?
Because the mining stocks in a major crash become correlated to the equity markets. Same things happens with real estate like REITs.
Gotcha.
And so when the equity markets crash, they crash because they're thinly traded. Like all the gold companies in the world have about a quarter of the market cap of Amazon. So any kind of selling pressure just annihilates them. Okay. So they in those conditions, normally the mining stocks are correlated to the gold price, but in a broad equity market decline, then they become correlated to the equity markets, not to the gold price.
Nick, you speak a lot about China buying gold. These are numbers that are, very difficult to get. We don't know how much gold China is buying since the central bank rarely releases these figures. What are insider sources telling you?
Well, all of the stuff I've read, that first of all, China supposedly has 1,600 tons in the central bank. And that's compared to 8,000 tons that the US supposedly has. So, but let's say the US does have 8,000 tons. China has made it publicly known that they intend to have more gold than the US, and the target is 10,000 tons. But the central bank has not been increasing. So what people expect is that the Chinese sovereign wealth fund is where the buying takes place. And the sovereign wealth fund does not report anything to anybody. And the estimates are that they'll have well above 6,000 tons already. Now, the problem with that becomes it's nice that they have 6,000 tons, but GFMS and CPM have accounted for every fraction of an ounce as far as I'm concerned, okay? And if China announces that they have 6,000 tons, where did they get it? Is going to be the question. And the answer is going to be that it was done through leasing to the bullion banks. The bullion banks deposited temporarily with the ETFs. When they redeem, they don't pay it back. They sell it to China in a sovereign wealth fund. So if China ever announces that we've got 10,000 tons, in a very short time, everybody will figure out that the Western central banks don't, particularly the US.
Nick, just to wrap here, we obviously have many audience members who've never purchased gold, who have a bit of gold, or perhaps feel fully comfortable in their allocation to gold. As we enter 2021, what would be your advice to these three different categories? So for those who don't own gold and are maybe looking at the price or thinking, it's just too high, I'd rather get back below 1,200. What would you say to them?
The first thing is educate yourself so you're comfortable, whether it's health or finance. You don't have to be a doctor, but you have to know enough so that you can make wise decisions. So start there. And the easiest thing to start accumulating is silver. It's only about 25 bucks a coin. And start there as slowly. And our funds are for registered accounts like RSPs and TFSAs and RESPs. So a lot of people have money in that, so you just have to allocate some to our funds. So it's straightforward and simple.
Thank you, Nick, and thank you for watching. We'll have much more for you as part of our Outlook series, Finding Equilibrium in 2021. So be sure to stay tuned to Stansberry Research and follow us on all our social media platforms. Thank you so much for watching. I'm Daniela Cambone.